Hello, I'm Brian Beaulieu. Thank you for joining us for this edition of FedWatch. Today is June 30th, 2023. Earlier this week, Chairman Powell was saying that there was a strong consensus, a majority consensus, as a matter of fact, that on the FOMC, the regulating body that decides where interest rates are going to go, that they want to increase interest rates 2 more times. He didn't say that that's going to happen, but he's making it pretty clear that if it doesn't happen, it's because the minority managed to somehow convince the majority not to do it. So it's not a great sign, not a great tell. Second thing that I want to cover is the stress tests were done on the 23 largest banks in the country. We started doing the stress testing following the 2008 financial crisis, and they test specifically the 23 largest so that they believe that's the bedrock, the core. These are the banks that are systemically too big to fail. And if they're okay, then most of everything else is going to be okay. And it was a pretty rigorous test. They assumed 40% drop off in commercial real estate prices, a significant drop in home prices, a deep recession, and 10% unemployment. And they concluded that the 23 largest banks are sturdy, solvent, resilient, and therefore that's a really good sign for the banking system. Still doesn't speak to how the smaller banks are exposed to the commercial real estate situation, but at least the systemic danger is limited, according to the Fed. The third thing I wanted to mention was in Chairman Powell's remarks yesterday, I believe it was, they are seeing labor supply imbalance easing. They acknowledge that nominal wages are not going up, participation rates are going up. Well, wages are going up, but not as rapidly. And that there is some easing, but it still is a concern for them. And that you went on to mention that core inflation obviously isn't dropping. So very, very mixed signals along those lines right now. Obviously, we don't know if they're going to raise interest rates again, but it wouldn't surprise me if they do. And we talked about this last time. The more they raise these interest rates, the further we get from having a normal yield curve. We're already 173 basis points inverted as of yesterday's market close, Wednesday's market close. So, you throw another 25 basis points on top of that, and you have to have 200 basis point plus decline just to get us into normal yield territory, which is something that has to happen if we're going to have the recovery that we're projecting. Then finally, the corporate profits data was out today. This is the fourth item. They were released on Thursday. We have run it through our analysis, obviously, and the trend is not good. Overall, corporate profits for domestic corporations fell for the second consecutive quarter. You may remember that I had mentioned that falling in the fourth quarter sometimes happens, but a first quarter decline in corporate profitability, not a good sign. And it wasn't just the financial stocks or financial entities that were dragging it down, although they're clearly the worst. I mean, their profits are down 22, 23% from 1 year ago, and they've been heading downward ever since the December high. But even non-financial corporations are having a slide in corporate profits. They're down 6% since the December 2022 high. Unusual to see that decline in non-financial companies in the first quarter. And it's normal. I mean, in magnitude. In other words, I can't tell you that it's light. I can't tell you that it's severe. But for non-financials, it's normal. For financials, it's quite severe, and that's enough to bring down the overall total. And the reason I saved this for last is it boggles my mind that the stock market continues to just blissfully go about its rise. It strikes me as incredible. But I'm often reminded that the stock market can be wrong, can afford to be wrong a lot longer than I can afford to be right. In other words, it can't fight the market. It's going to do what it's going to do. But these underlying trends, this is like the sand eroding off the beach when these profits are going down and the stock's going up. That's not a tenable situation. So mixed news on the Fed side of things, and don't like where these corporate profits are going. We're on track for this recession. What we're really worried about is the timing of the recovery. No reason to change it right now. Consumers in good shape. We'll talk a little bit more about that next week. Thanks for watching this edition of FedWatch.